All right, guys, thank you for showing up here. I got a question for you. How many people have ever heard the expression, if it sounds too good to be true, then it probably is? And how many of you have wanted more money for basically anything in your life? If you answer yes to either one of those questions, then you're in the right place because today I'm going to share with you a very little known but powerful wealth building strategy that can completely change your financial future. We're going to talk about your wealth. We're going to talk about how you can live life like the wealthy by using their own techniques. And we're going to cover how you can keep control of your money, to how you can build wealth, and how you can keep all the money in your family, how to pay off debt, expenses, and overhead by recycling and recapturing the money, just like banks do. Now, this is out of the box thinking. So I challenge you to keep an open mind because I'm not selling you anything. I'm simply teaching you a process and educating you on how it works. So as we go through this, you're going to have some questions. So just kind of think about those questions, maybe write them down. Let's jump into it. So there's a quote by this guy, Will Rogers. The quote goes, "The problem in America isn't so much what people don't know, is what people think they know that just ain't so." This is a really, really good quote. And the reason why is so true, because a lot of us have been taught something about money, how money works, and it just isn't true. So I need you to keep an open mind because this webinar, I'm gonna be challenging you what you think about money and about what you've been taught about money, because what you've been taught just isn't true. So just keep an open mind as we go through this. So I want you to think about this. Think about, you got 100 18-year-olds all gathered in a room. You ask every single last one of them at 18 years old, where are they going to be when they retire? And every last one of them are going to tell you they're going to be a wild success. They're going to be millionaires. Now they're billionaires. Now, fast forward to when they are retired. The fact of the matter is only 5% of those 100 children will be financially secure by the time they're retirement age. Now, that's crazy. Now, how's that possible? Even in America, the land of the free, the wealthiest country in the world. How is it that only 5 of us out of 100 become financially secure in the time of retirement age? It's because of what we're taught. We're taught lies about money. All right. So I need you to keep an open mind because I'm going to challenge you on how you think about money. Now, what I just gave you, that is a real statistic. That is from the Social Security Administration. Only 5% of Americans be financially independent. So we're going to go over exactly what the wealthy do, how they build generational wealth. Now, before we get into that, let me just kind of give you my backstory. My sister and I were born in Philadelphia. We were raised by my chef mother and my beauty salon owner, entrepreneur, turned minister mother. So you can say that I am a beautiful cook for the Lord. My wife might not agree with you, but we were probably considered lower middle class. And my dad worked away from home, so I didn't see him a lot. I mean, he came home, but he just worked a job. And my mother had she was a little bit more accessible. So I went to high school for the creative and performing arts, and I also went to University of the Arts. So you've seen some of my videos, you probably will understand that makes sense. And I have some celebrity friends. I'm not going to drop any names. They pursued the industry full force. Before I finished my last year of college, I moved to California and I lived there for a little while to try to work the industry. I realized I didn't like it. So I came back to Philly, graduated from school, I got my receipt, some people call it a degree, and I quickly realized that I enjoyed entrepreneurship more than anything else. So I joined multiple multi-level marketing companies, and I'm going to tell you right now, multi-level marketing it is not entrepreneurship. It is not entrepreneurship. But I made a lot of money in the 90s with one company in particular. When I left that company, I was when I was on my way to leaving that company to try to figure out what I was going to do next, I was living off my savings. I met my wife and was just kind of looking for that next thing that I was going to do. So fast forward, after cars repossessed, home almost in foreclosure, and we lost a daughter. And I have to tell you that was one of the hardest things that we had to overcome. Not about the cars, not about the home. It was losing a daughter, and going through that whole process. I don't wish that on my worst enemy, but going through that was something that we didn't expect. It wasn't something that we could even predict. But it was a challenge. So that challenge kind of just affected the rest of our life, and that's after that I decided to go into the life insurance industry. Not really wanting to, but I just thought that there was a real need there. And because she had a hard time getting covered because of her condition. And when we finally did find her coverage, it was a relief. But to know that there was something there when we needed it, it was just it just lifted a little bit of the burden off of us. But that was how I kind of entered into this industry. And for the last 10 years, I've been helping people in the final expense industry. And final expense is just life insurance, but it's a particular type of life insurance. And this is what I've been doing for the last 10 years. Made a lot of money. And as you watch this video, you understand why I'm upset with the money that I made, and I lost millions without knowing about this concept. So consistently made six figures, and what happened was the pandemic. So it changed everybody's life, right? So during the pandemic, I decided that I wanted to figure out a way that I didn't ever have to go back in the field and talk to people at their homes, and because I really didn't like knocking on doors and things like that. So I created a software system. It's called a SaaS, software as a service, for final expense agents, so they didn't have to go out and they could have a virtual final expense business and work from anywhere just by using the phone. And that was kind of like the thing that I said, this is going to be about my end game. And I didn't know as much as I do know about infinite banking. Wish I did, but I didn't. In early summer 2022, I fell off my mountain bike, had to have surgery, broke my proximal humerus bone, and had to have surgery. And the night of my surgery, I couldn't sleep. But I came across this video, stumbled on this video. It was 36 seconds long. I watched this video. It was about infinite banking and how you buy a car with infinite banking. I watched this video 15 times. I couldn't sleep. That was the beginning of my journey. And so every time I watched it, I learned more and more and more about it. So that's when I decided I had the answer. And I knew that even more, I was even more excited when my wife was excited, because she had never really got excited like this about anything that I had done. So I look forward to helping a ton of people solve all the problems that they have with money. And that's kind of why we're here right now. Just understand, like, I'm on a mission to really help people kind of get to where I've gotten, to understanding that this works. Anybody can do it. Average people. I'm nothing special. Anybody can do it. So hopefully you get a ton of value from this, and I can help out some people. What I'm about to go over is not a new concept. It's actually been around for a very, very long time. We're talking about several hundreds of years. And there's people who've actually known about this that you actually know about. So question before you. Who here has ever heard of the book Rich Dad, Poor Dad by Robert T. Kiyosaki? Everybody heard that book? That's one of the best books for financial literacy. Now, Robert T. Kiyosaki, he writes about this concept in his book, Second Chance. Here's another guy I know you guys heard of, Tony Robbins. He talked about Money Master the Game. It's a phenomenal book. The holy grail of this concept, the Bible, is becoming your own banker. When I read this book, my mind was blown away. I read it cover to cover at least 4 or 5 times. It's an easy read. I suggest you guys read these books, along with mapping out the Millionaire Mystery, Grant Kessler and Chris Nagel. And then Chris Nagel wrote another book, The Private Money Guide by Chris Nagel. So read these books, because these books will give you insight on this concept and the fact that it can change your life. Let's get into this now. What you see on your screen is a backwards bicycle. I want you guys, when you have a chance, to go to YouTube the backwards bicycle. See, from a young age, we're taught how to ride a bike. You hold the handlebars. You turn the wheel right. Turn the handlebars right. The wheel goes right. You turn them left. The wheel goes left. That's what we're taught. So we get on a bike. That's how it operates. But if you were to change just one thing about that bike, that is, you turn those handlebars right and it goes left. Turn the handlebars left and it goes right. How many of you think you could ride that bicycle? The answer is probably none of you. That video is so funny. This guy tries to ride the backwards bicycle, and he can't get more than a couple of inches. Eventually, he learns how to re-ride a bicycle. Your money is very similar to this. And I'm going to talk about this today. It's simply changing one thing about money. That's it. Just one thing. Not multiple things, one thing. You change that one thing, it's going to throw you off. It's going to be difficult because you've been taught your entire life something different. You've been taught basically a lie. So right now, we're going to jump into exactly how this works. First, we need to talk about the mysteries of money, what you've been taught about money. First, what is money? What is the definition of money, right? The definition of money is simply a means of exchange. That's it, nothing else. So I got money, I give money for phone for money. If I have money, I get money for car for money. If I want a house, money for house, house for money. It's just a means of exchange. Let me ask you something. What business uses compound interest? A lot of people think banks use compound interest. They don't. They charge interest, but they don't use compound interest. They don't use it themselves. See, for compound interest to work, the money has to sit. And there's not one company, one bank that's going to let money sit. They move it. Yet we're taught to let money sit in the bank, sit in a retirement account. Yet the wealthiest companies, the banks that have all the money, they don't let money sit. They don't do what we are taught to do. As soon as you put money in the bank, they lend it out. And the way you can verify this, if you have $100, write your name on it. They're not going to take that and put that money in the back with your name on it, and then you come back and get it and it has your name on it. No. As soon as you put your money in the bank, they deploy it to make more money. Now that we know that no company lets money sit, let's talk about, are your dollars worth more today or in the future? Just hopefully you know they're worth more today. Because of inflation, your money will be worth less tomorrow. The day after, your money will never be as valuable as it is today. Think about how many candy bars you could have bought with $1 20, 30 years ago. The answer is more than today. Money is always worth the most today. Think about this. We are taught to not spend our money today. We're taught to save it and to spend it later. It's worth less. It makes no sense. We've been taught lies. I'm just trying to get you guys to think about what's really going on, right? Think about how we've been taught. Think about this. Do taxes go up or do taxes go down? They go up all the time. When the tax code came about in 1913, the highest tax bracket was 8%. The highest, right? Now the highest is like 40%. And taxes never go down. They always go up over time. But we're taught to avoid paying taxes now. That's why people got 401ks, because they're tax deferred, because you don't pay taxes now. When they're probably the lowest, they pay it later when they're most likely going to be higher. So it makes no sense. But this is what we've been taught. Now, think about this. We do things with money that we would never do with things that money buys. Think about this. Would you go buy a loaf of bread or a gallon of milk and just wait and hold on to it when it's the freshest, and just don't drink that milk or bread? Just hold on to it and put it away. You wouldn't do that. You take money, you put in investment, a 401k, an IRA, and you wait 10, 15, 20 years before you actually use it. A lot of people are going to say, my company gives me a match. They match the money. Think about this. If you go to the store, you buy a loaf of bread, you put it in the freezer, and you wait 10, 15, 20 years, and you go open it to eat the bread, it's freezer burned, right? But now you got two of them. They're still worthless when you could have had the bread when it was at its best. Again, I just want you to think about what's really happening. All right. So what do you actually know about your retirement account? What do you actually know? Think about this. Your 401k, what do you actually know about it? Who controls that money? It's not you. You give up control of that money. Before you even touch it, you give a direct deposit. Before the money hits your account, the money for the 401k is out. So before you even touch the money, you give a control of the money. Let me just try to get you to think about how things really work, how we've been taught. We've been taught incorrectly. We've been taught not spend money now when it's worth the most, not pay taxes now when they're probably the least, to spend the money later when it's worth less, to be taxed more, and to be taxed on the harvest when we should pay taxes on the seed, not on the harvest. We are taught the absolute wrong way, lies. So what we're going to talk about today is spending your good dollars now, but giving you the ability to spend and still grow wealth, extreme wealth, generational wealth, just like the wealthy do, just like the bank does. So after this webinar, hopefully you'll understand how money actually works, how your money flows. Now, if you know what's going on, you'll know what to do. So let's talk about how money flows. Let's say that you're going to buy a car for $25,000. I don't want you to get hung up on the type of car, if it's a Honda or Rolls Royce. The price is irrelevant. It will work for a Honda or Rolls Royce. It doesn't matter. It's going to work. What I want you to really understand this part, to understand infinite banking. Let's assume that you're saving money in your bank, your local bank, and I'm going to play your local banker, Banker Will. Let's say you have $25,000 in the bank, and let's say it's earning you 4% interest. Now, I know it's no bank that's going to give you 4% interest, but you just found a really, really good bank, right? So you come to your bank, you say, Will, I want to take out $25,000 that's earning me 4% interest, and I want to go buy a car. What I would tell you instead, don't do that. Instead of taking the money out, I'm going to give you a loan for $25,000. Use your money as collateral, and you pay me 6% interest. However, you will earn more by getting 4% interest than you would paying 6% interest. Am I being honest as the banker? Am I telling you the truth? The answer is absolutely yes. And it's really, really simple. It's really simple. The reason why is because of the difference between simple and compound interest. Now, if you can understand this, infinite banking is super easy. So here's the thing. If you got a car payment, $25,000, 6% interest for 5 years, 60 months, you'll end up paying $483.32 per month. Numbers don't lie. For 60 months, you're going to end up paying $28,999 for that car, right? Get this. Your $25,000 at 4% in the bank, your future value is $30,525. So you actually make $1,526. That's because of the difference between simple and compound interest. On your car payment, 6%, every time you make a payment, the balance goes down. So you're paying less interest every single payment. On your money in the bank, your balance is going up. So you're earning more interest every single time. It's plain and simple. You can earn more earning 4% than you could ever pay being charged 6%. So let's talk about the money multiplier method, the infinite banking. We're going to talk about the machine that's going to keep your money flowing, that's going to keep the money coming back to you, staying within your family for the rest of your life. We're going to talk about the marathon, that this is a marathon. In fact, this is America. It is not a sprint. You're not going to get wealthy overnight. And if you do, you're going to lose it because you don't know how to keep the money. Think about pro athletes. They become very, very rich very, very quickly. And a lot of them become bankrupt very quickly after the money stops. That's because they do not know how to keep money and how to keep it flowing in their favor. All right. We're going to talk about that. We're also going to talk about becoming a millionaire, right? Everybody wants to be a millionaire. Pretty soon, millionaire is not going to be a big deal. Well, probably right now, everybody wants to be a billionaire. We're going to talk about how to get there. And it's not difficult. It's not, you just got to know what to do. And you just have to do it. All right. So let's jump right into it. All right. Let's talk about the machine. The machine that you're going to use is nothing more than a dividend-paying whole life insurance policy with a mutually owned company. You might be thinking, why in the world would we use life insurance? When I first learned this, I was like, life insurance? I don't need any more life insurance. I mean, that's just crazy. But see, that's what most people think. However, we use life insurance because that's what the wealthy do, what the elite do, what the banks do. Banks own more life insurance than anyone. They're the number one purchaser of life insurance in the world. They own billions and billions of dollars in life insurance. And if you don't believe it, go ahead and Google BOLI, B-O-L-I, bank-owned life insurance. They own more life insurance than all the land and buildings combined. And it's not like they own crappy buildings. They own nice buildings. They own real estate and the land. And that land is in very desirable areas, on corners, expensive lots, and they own the buildings. They own more whole life insurance than anything else. They don't do that because they're stupid. They do that because they know something that we don't know. And they also use life insurance because all the growth is tax-free. See, the tax code came around 1913. Life insurance has been around since the 1700s. All the growth is tax-free, and all the growth is 100% guaranteed. That's why we use life insurance as the machine to flow your money. Remember how I told you you can make more money earning 4% while paying 6%? See, your policy the same way. You take a loan from your policy, and you're still earning money that you put in. The difference is now you control both aspects, the loan portion and the savings account. You're in control of both. You're the bank. So let's talk about how banks utilize this. So imagine you deposit $100,000 into the bank. The bank pays you 4%, but they don't do that. But the bank does not hold the money. They immediately get rid of it because, see, think about it. The bank pays you 4%. It's a liability to them because they have to pay you 4% on $100,000. So what does the bank do? They lend your money out, right? So let's just say your money, lends your money out on a house at 7%. Don't get caught up on the numbers. Just focus on this concept of what's actually happening, right? So the bank, they pay you 4%, but they lend your money at 7%. Now they're in control. They're in control. So when the person gets to home, they have to do a credit check. If their credit is good, If the credit's bad, they charge more interest, right? So they really don't have very much risk, and they're not using their money. So it's very little risk. So they lend your money out. What happens? The person that bought the house, they get the keys. The seller gets the money. The person that bought the house gets keys. Seller gets the money. What do? They don't put the money in the mattress. They put it right back to the bank. So it comes right back to the bank. So what does the bank do? They don't hold it. They get rid of it. They lend it out again. So let's say now they lend it out on the car, right? They're going to lend it out on the car at 8%, because a car loan is a little bit more riskier than a home loan. So it's going to be a little bit more interest. So they're going to lend it out at 8%. What happens? The money goes to the dealership. And what does the dealership do? They take the money, put it right back in the bank. They're not holding the money. No, it goes right back to the bank. What does the bank do? They immediately lend it out again. Let's say they just do it on a second mortgage on the house. So now they got a home remodel. Again, the bank is in control because the second lien position is more risk. So the bank charges more interest than the first lien. The first lien is 7%. Now they're charging 9%. What happens though? As the money goes to the contractors, what do the contractors do? They put the money right back in the bank. They're not keeping it in wads of cash in their backyard. They're putting it right back in the bank. The money is continually flowing into the bank and out of the bank, into the bank and out of the bank. That's just the flow of money. The more it flows, the more it grows. So let's say that somebody's racked up a bunch of credit card debt and they want to get a debt consolidation loan. So it's a higher interest rate because there's no collateral. Think about it. Before it's a house, the car is collateral. Now there's no collateral. So it's a higher interest. So the bank is in control. They charge 12%. Now what happens? They pay off the credit card. What do the credit card companies do? They put the money back in the bank. The bank is always in control. They're always winning. So here's the crazy part. It's your money that they're in control of. Let's talk about how much money the bank made. So on the house, they paid you 4, they made 7. So they have a 3% spread. On the car, they paid you 4, they made 8. So they got a 4% spread. On the home remodel, they paid you 4 and they made 9, 5%. Debt consolidated, paid you 4 and 8% spread. All right. If you add that up, how much did the bank make? Most people would say the bank made 20%. Problem is, that's not accurate. They made far more. Because remember, they're not using their money, they're using your money. The only money they have in this process is the interest that they were paying you. So 4%, they took 4% and they turned it into 20%. That is a 500% return using your money. It's crazy. The more the banks do this, the more money they make. And you can mimic the bank. You can do this. You can do this instead of letting the bank do it. You can do this. If you don't believe me, go to Bauer Financial. Look at any bank. Bank down the road, look at this year, last year. Doesn't matter. There's no banks that make less than 400 to 1,300% on the money you leave there. It's crazy, right? So why do you let the bank do that with your money when you can do that simply mimicking what they can do? All right, so how we're going to do this is really simple. Let's talk about how people spend money so you can mimic what the bank does. This is how people spend money. Every dollar, the average American spends about 20 cents out of every dollar on automobile, payments, gas, upkeep, etc. 30% or 30 cents on every dollar is the housing, mortgage payment, taxes, insurance, things like that. 40 cents out of every dollar goes to everything else. So we talk about travel, entertainment, food, travel, clothing, whatever. Out of 10 cents out of every dollar is for saving. And that's being generous. Since the meltdown of 2008, the average savings in America is right around 5 to 6%. So this is being really generous. But the crazy thing is that most financial gurus and financial advisors, CFPs, they will tell you, take your savings and go make a bigger return. But tell me, if you want to make a bigger return, what happens? You have more risk. The older you get, how much risk do you really want to take? I don't want to take risk right now, let alone, 10 years, 20 years from now, right? So they'll tell you, take your savings, take on more risk, get a bigger return. It doesn't make sense. It's backwards. We've been taught lies. So I don't want you to change anything about what you're doing. I just want you to control where the money goes. Now think about this. Out of every dollar you spend, 20 cents of this goes to automobiles. Out of that 20 cents, 5 cents of that's interest. So what if you can just get that interest back? Instead of paying it to the bank, what if you can get it back yourself? So you got 20 cents every dollar going to automobiles, 5 cents going to interest. Take that 5 cents and put in your savings. Now you're just giving yourself a 50% increase in your savings. But most financial gurus will tell you, take your savings and go make a return. Where can you make a 50% return without having ridiculous risk? This is not a risk. This is simply controlling who gets the interest. That's it. Now, on your housing, 30 cents out of every dollar goes towards housing. Of that 30 cents, 25 cents of that is interest. If you just take that and put it back to your savings, look at the difference. Some of you might be thinking, how could 25 cents housing be interest? That makes no sense. Go look at your mortgage statement, 30-year mortgage. First 7 to 8 years, 90% of it is interest. And the banks know this. They know it's not about the interest rate. It's about the volume of interest. They know that most people do not stay in a house for more than 7 years. And if they do, they're going to refinance to get a lower rate. Now think about when the rates drop to 1.9%. Everybody was trying to get refinanced, right? The bank is the only one that's winning. You get a low 1.9, but the bank just reset the clock. Now they got the volume of interest on their side. They're always in control. We're taught that the interest rate matters. It's not about the rate. It's about the volume of interest, all right? So if you got everything else you got in your life, 40 cents on every dollar, about 5 cents is interest. If you control where the interest goes and put it back in your savings, look at the difference you made. And you haven't taken on any risk, any more risk. You haven't had to work any more harder, any longer. You've not lost control of your money. You have control. That's what this is all about. You having control. So I like this one. I wish I would have noticed a long time ago. I'm going to show you how to get all the money back on every car that you ever buy, drive, or own. You heard exactly what I said. Every car you ever drive, buy, and own, you get the money back for. All right. So let's talk about the machine first. The machine, you really just need to change your mindset about this. People think about life insurance. They think about premium. They think about it as a bill. Because most of the time, you have home insurance as a bill you got to pay. You have health insurance as a bill you have to pay. Life insurance is completely different. If it's structured correctly, it's a deposit. When you deposit money in the bank, you can go use the money right away. It's liquid, right? I never met one person who doesn't want to deposit more money in the bank. If your insurance policy structured correctly, it works just like that. It's a deposit because you can immediately use it. So let's change the way we think about premiums. Think of it as a deposit. From now on, I'll just say deposit because your premiums are deposit. You put it in, you're able to use it. I also want you to think about age. It doesn't matter about age. There's clients that are 18 years old. There's clients that are 68 years old. It doesn't matter. Only difference is the older you are, technically, the less time you have to live, with all things considered. So that means less time your money has to grow. So the only difference is your death benefit won't be as high. Death benefit doesn't really matter. We're not doing this for a death benefit. We're doing it for cash value, control, being able to become the bank. It doesn't matter. Age doesn't matter. Doesn't matter. Okay, so let's jump into it. Let's show you how to get all the money back for every car you ever own, drive, or buy. So let's say you're planning to buy the car in the next 3 years. Don't get hung up on the numbers. Just focus on the concept. It's a work on regardless of numbers. Just examples. So let's just say for the next 7 years, you're going to deposit $10,000 a year into your banking policy. Now, year 3, you can go ahead and buy your car for $25,000. Now, think about this. If you bought a car from a dealership, you would get a loan from the bank. You would pay that payment on time without fail every month because you don't want your credit to go bad. And that payment to the bank is interest. So if you pay the bank interest every single time you borrow that money without fail, you should pay yourself interest every time you borrow money from yourself without fail. So that's very important. All right. So you buy a car, 25 grand from your policy. Now, you're going to pay yourself back just like you would pay the bank back. Over the next 5 years, you're going to pay yourself $500 a month, $6,000 a year for 5 years. I'm just using 5 years because it's a very common car loan term. So what this means is over 7 years, you have deposited $70,000 into your policy. You paid yourself back $30,000 into your banking policy. So you had a gross amount of $100,000, right? We use 25 to buy the car, but your net about is $75,000. Look at your cash value. $67,880. That means you got back 91 cents on every dollar you spent on that car. And you still own the car. It's still sitting in your driveway, paid off, free and clear. You got 91 cents out of every dollar you spent. But I didn't say how to get 91 cents back. I said how to get every single dollar back. So we don't drive cars forever. So after 5 years, you're probably going to get another car, right? Year 8 through year 12. I'm just going to assume you're not depositing any more money in your banking system. Once you fully understand it, you're never going to want to stop putting money into it. But just to prove a point, let's just say you don't put another dollar in there. You buy the car for $25,000. Again, you're the bank. You got to be an honest banker. You got to pay yourself back, just like you would pay the bank if you would have borrowed their money. So you're going to pay yourself back again, $6,000 a year for 5 years. So that means you have put in $30,000 into your policy, and you borrowed $25,000. What that means that your net injection was $5,000. But look where your cash value is, $91,473 from $67,881. That's crazy. That means that your cash value grew by $23,000. Right? Now you got another car sitting in your driveway, free and clear. This is incredible. This concept will work with anything. And then only just 3 rules. Pay yourself first. We're taught to take our money to pay everybody else before we pay ourselves. Cars, our housing, everything else. And then we put money in our savings. What I want you to do is pay yourself first. Put your money in a policy first, then spend the money. Because once it's in a policy, it's guaranteed to grow, even while you use it. If it's guaranteed to grow tax-free, you should put as much as possible. The more you put in, the bigger it gets. The more you put in, the early on in your life, the longer it has to grow. So your goal should always be to pay yourself first. Second thing is pay yourself with interest. That's second rule. Pay yourself with interest. We're taught to borrow money from people, banks, family, wherever, and we're taught to pay them interest. But if we pay them interest for borrowing their money, we definitely should have paid ourselves interest for borrowing our own money. Because if we don't, we're saying that their money is more valuable. That doesn't make sense. Our money should be the most valuable, right? So always pay yourself with interest. Third thing, just recycle and recapture your money. Just keep doing it. Remember, just like the bank, they let their money out, came back to the bank, they let it out again. It came back, they let it out. You should always be doing that. When you get a policy, use it to make more money, to buy things that you would have normally bought from the bank, but you simply pay it back from the policy. Pay yourself back with interest. Just get the money paying back to you. Just recapture your money. If you do that, you'll never have a dollar leave your family. Every time you spend money that's not in the policy first, that money's gone forever. You can't get that money back. Worse than that, you've lost that money's ability to grow for the rest of your life. So if you have $1 compounding for the rest of your life, your growth is going to be a lot more. So every single dollar you have, first put in the policy, let it get recaptured. And if it works for a car, what else would it work for? A boat, a house, a wine cellar, more cars, backyard remodel, bathroom remodel, anything, right? It works. We've been on vacations. We used it. Instead of using our own money or the bank's money, we'll take the money from the policy and just recycle it. So let's jump into another thing that you can do. All right. So huge problem out there. Debt, a lot of consumer debt. Because as Americans, we like to spend money. We like to spend money we don't have. So we go into debt. We had to pay other people money, the bank. So let me give you guys an example of one of the clients that we had. See all these debts that they have on the screen. 9 debts: Discover, Lowe's, Nordstrom, Wells Fargo, private loan, BMW, boat, condo, house. She's paying all this interest per month. All this interest to other people. $478,000 in debt. Total payments of $69,000 a year, leaving his family, 69 grand. He'll never get back. It will not compound for the rest of his life. So this guy was a chiropractor, right? He had all these debts, and he had a savings of $25,000 a year, right? His plan was to take 25 grand and pay down his debt. That was his plan. That's most people's plan. Take the money they have, pay off their debt. With his plan, he was going to get out of debt in 19 years. 19 years. It's a good plan. Get out of debt in 19 years. However, what we did was taught him how to change just one thing to get his debt paid off a lot faster, like a fraction of the time. I'll show you how we did it. By changing just one thing, that's where his money goes first. So $25,000 he had, instead of paying his debt off, first we're going to deposit it into his banking policy and then pay the debts off. So watch how this works. Year 1 of his policy, he puts in $25,000. He got a cash value of $14,863 immediately in the first 30 days. So we had him take the 14,000, pay off the Discover, pay off the Lowe's, and pay down the Nordstroms. Now, these two payments, Discover and Lowe's, he no longer has to pay. But remember, if you're going to pay someone else interest, you better pay yourself interest. All we're going to do is that money he was spending, the $161 a month and the $287 a month, included 11% interest and 21% interest. So all we're going to do is take that amount and pay it back to him. He's going to keep it. So watch how this works. Year two. So $448 from those two payments that he now recaptured, that he's keeping, he's recaptured, and he's putting back in his family instead of going to Discover and Load. So year two, he's got $25,000 deposit in policy. His cash value is now $16,571. And remember, he was paying himself $448 a month. So that comes to $5,374, $21,900, almost $22,000. So he takes this Nordstrom's, Wells Fargo's private loan, and pays down the BMW. So again, he's going to pay Honest Baker the money he used to pay them. He's just going to keep it coming back to himself, right? So he's now got $1,917 that he's getting instead of the bank. He's being an honest banker. He's paying himself back, just like he would have paid back the bank. So he's getting the interest that he used to pay to them. So year three, $25,000 in his policy. Here's where it gets good. Every policy has an efficiency point. You can see his cash value is now higher than what he put in. After the efficiency point, your cash value is higher than what you put in. The spread keeps growing more and more. It gets more efficient. That's why you never want to stop putting money in. Because if you can go put $25,000 in the bank and they only give you back $25,541, you would never, ever stop paying the bank. So remember, he was paying himself $19.17 per month. All right. He was recapturing. Now he's recapturing $48,545 a month. So he pays off the BMW, pays off his boat, and pays off a little bit on the condo. So now, being an honest banker, he's going to recapture the money from the boat and the BMW. Now it's $3,600 that he's recapturing that he used to give to other people. Now he's keeping it. So this is where you have to understand this is a marathon, not a sprint. So now think about year one, year two, and year three. He's deposited $75,000, rounded up. You took a year one, 14 loan for 14, 16, and then 25. So he's taking loans for 55,000. How much does he have left in his policy? Most people would say 20 grand because he put in 75. He's got loans of 55. It's not correct. He still has 75 grand sitting there compounding. Because remember, he's not using his money. The money you put in the policy, it just sits there and compounds. It's collateral to get a loan from an insurance company. You're just borrowing their money. His money's sitting there compounding and growing. It's still earning on a guaranteed growth. It's a marathon, not a sprint. Because year four, he's going to put in $25,000. Cash value is $26,304. He's got $70,000. He's been saving. He doesn't have enough to pay off the condo. He's $70,439. Nothing changes. That's why it's a marathon, not a sprint. Take the $70,000, pays down the condo. Nothing going to change but the cash flow. Okay, $36.77 per month that he recaptured. $2,100 that you pay on the condo in the house. So it's going to year five. Year five, $25,000 deposit, cash value about $27,000, $44,000 in payment recapture is $71,000. Pay off the condo, pay down the house. Now that's another $879 that he doesn't have to get to the bank. He can recapture. He's getting the interest. He is the bank now. So year six, this is where it gets a little tricky, right? With policies, you can only put so much in them before they become taxable. At this point, he can only put in $10,000 into the policy. He can no longer put in $25,000. So he puts in $10,000, but his cash value is $13,000. If you can go to your bank and put in $10,000 and get $13,000 out, you would do that all day long. You would find $10,000 somewhere, somehow, and you put it right back in the bank to get $13,000 back. So since he's only able to put in 10, what he does is he starts another policy to avoid the taxation. This is why a lot of people have 9, 10 policies, because you can only put so much into a policy. Once you get to that point, you start another one. Once you get to that point, you start another one. So you can have multiple policies, right? So he starts another policy, $25,000, has a cash value immediate of $14,863. Remember, he's been paying himself back for all of the interest that he's getting, 54 and some change, all back, 82 grand back, right? Pays off the house. He has $0 now going to the bank, and everything is staying in his family forever. He's not giving them control of his money. Think about that. The original plan was to take 25,000 to savings. It's going to take 19 years. And we just showed you how he got out of debt in 6.5. He didn't work any harder. He didn't take on any risk. All he did was change where his money went first. Change one thing. Remember, it's the backwards bicycle. We just changed one thing. We just changed where the money went first. First went to a policy, then it paid off the debt. Goes to the policy, pays off. Now we paid off everything in a third of the time. It's incredible, right? The cool thing about our company is we teach the infinite banking concept. We sell policies and help you do the concept. Because once the policy's set up, we don't just say, just here you go, goodbye. We give you a debt map. If you're trying to do something else with the funds and you don't have debt, we're going to map out how you can use your policy, just like we did with the chiropractor. So you're going to get someone who's there to help you implement the policy. And that is just saying, okay, you're good. Good luck. Go do it on your own. We're here to make sure you take back control of your money and help you become your own bank. So every one of our clients get this debt map. All right. So let's talk about this last thing. We talked about a machine. We talked about the fact it's a marathon. Let's talk about being a millionaire. How do you eat an elephant? Some people know, one bite at a time. The man on top of the mountain, he did not just fall there. It takes time. It is a marathon, not a sprint. Okay. It can take a few years to really get your banking system at its peak efficiency. So policies will start getting to efficiency. Everything after that efficiency point will be crazy. Like the first year, I used my policy so much, but understand something. Nothing worthwhile happens overnight. It's nothing different. This is nothing different. So what if you don't have any debt? Then you can do other things with the policy. You can do other things in infinite banking. Could go do real estate. You can go use the policy to go pay your taxes, to take vacations. You can do anything that you would normally use money for from the bank. You can use your policy now. All you got to do is make sure you do 3 things. Pay yourself first, pay yourself with interest, and always recapture and recycle. As long as you do that, you can use infinite banking for anything. It doesn't matter what it is. If the chiropractor continued to pay himself back on just the houses, all right, watch this crazy. The condos were $879. We paid him out. 251 paid us left. That's $220,000 that we pay back to himself. In the house, 1221 with a payment, 224 months, 273,000. Almost 500 grand. Now he gets to flow through his bank instead of going to someone else's bank. But it gets gooder and gooder. The money you put in the policy, it grows tax-free. All right. So let's say the interest rate is a 4% interest rate. 220,000 growing at 4% is 344,000 that you get to keep. On the house, 405. That's $749,000. Plus you have the house, you have the condo, it's paid off. So you can go sell them if you want to. Take the proceeds, put into more compound interest policies, and just keep everything flowing. The possibilities are endless. That's why it's called infinite banking for a reason, because it's infinite what you can do. So now that you guys know this, everyone should do it. Because if you don't do it, you're stealing from your children and your grandchildren. Think about it. Every time you spend $1 that doesn't go through your policy, it's gone. It'll never grow again. But if you simply put in a policy first, it's guaranteed to grow and compound for the rest of your life, even while you use it. And by the way, we never talked about this. One day you're going to pass away. It gives you a tax-free death benefit. So let's talk about what we didn't go over. So it gives you a death benefit. We don't design these for the death benefit, but it gives you one nevertheless. And the way it works is incredible. The more money you put into a policy, the bigger the cash value gets, the bigger the death benefit gets. So there are policies where your death benefit was $100,000. By the time you're 70, it's $7 million. Because as your money grows, the death benefit grows. We never talked about that. The loans, never talked about that. You never have to pay them back. The insurance company will never ask you for $1 for that because they're advanced of the future death benefit. If you never pay it back, it just gets deducted from the death benefit. You should pay it back, but you don't have to because you want your family to get the full value of the death benefit. So we really didn't talk about the internal values grow tax-free, 100% tax-free. Think about if you're earning 4 to 5% tax-free. That's like making 7 to 8% before taxes. So most people would like to make a steady 7 to 8% all day long. But where can you really do that without all the risk? So internal values grow 100% tax-free. We didn't talk about the money that grows inside your policy is exempt from judgment liens in most states. So the money that goes into a policy is protected. It is the safest, in my opinion, to put money. It can't be touched on a judgment lawsuit. Every dollar you capture first should flow through your policy. Then you should use it to either buy things that we usually borrow money for or to make more money. Just constantly recapture the interest. So everybody knows this guy, Warren Buffett. He said if poor people would just do what rich people do, they wouldn't be poor anymore. So true. Like, how often do you study wealthy people? Now that you know what wealthy people do, what the rich do, all you got to do is just do it. Warren Buffett has his own insurance company, Berkshire Hathaway. So at the end of the day, it's all about what you know. And once you know the truth, it's about what you do with it. All right. Last thing, I'm going to leave you with this. One or two things are going to happen to everybody, no matter what. Only one or two things on a daily basis. We're either going to live, and if we live, are we better with or without a policy? Now that you guys know everything I just showed you, we're better with a policy, or we're going to die. And are we better with or without a policy if we die? Better with, because if we pass away and we have a policy, our family gets a tax-free death benefit. But think about it. If you're 30 years old, let's say you make $100,000 a year and you pass away, you have a wife and a kid, or husband, when you pass away, and let's say you would have worked till you're 65, that's 35 years of at least $100,000 that they will no longer see. It's crazy, right? We're 100% better off with policies, whether we live or whether we die. So that's it. That's the webinar. I hope you guys got a lot of value from that. I hope you do. I hope it really changes the way you think about money. And you're going to have access to calendars to book a phone call. It'll be either with somebody from my team or possibly with me. So if I end up talking to you, great. I look forward to it. If you talk to someone on my team, we're here to help answer your question that you may not understand still. And if you're ready, we'll just set you up with a policy. You don't have to pay us a penny. We'll never ask you for $1 to help you set up the policy. Like I said, once it's set up, we're going to show you how to use it. So I hope you guys have a super fantastic day. Stay blessed. And I thank you so much for spending time with me and paying attention. Take care. Bye-bye.